So oftentimes you find a company and you don't even know where to start. But one of the most important aspects of investing is understanding whether a stock is over or undervalued, and there's many ways to go about that. Now, one of the easiest ways for comparison is looking at financial ratios. Now, it's not to say that all you need to do is look at these ratios and that'll tell you everything you need to know, but as with most things in life, it is one of many components that can help you ground yourself a little bit. And so we're talking here about intrinsic value. And intrinsic value is calculated most often by a deep dive of fundamental analysis. And oftentimes it diverges from what the market price will be because so much goes into a market price. And so one way to, along with doing analysis, understand if something is under or overvalued is look at these ratios, right? And so we're going to go over some of these ratios right now. The first, price to earnings. This is comparing a stock's price to, you guessed it, its earnings. A high price to earnings implies that something may be overvalued, but it also suggests a lot of optimism, that earnings will grow far into the future. The opposite, low priced earnings, can signal some trouble. Going off of this, there's also the PEG ratio, price to earnings growth. What it does is it adjusts your P to E for growth. A PEG under 1 often suggests undervaluation, but accuracy really depends on the forecast of your growth rate. There's also price to book. That's looking at the market cap value of your shares relative to the book value of your assets. This is what the research by Fama and French three-factor model looked at to determine value stocks and growth stocks. So a lower price to book means you're paying less for the assets, and a higher price to book means you're paying more for them. There's also price to dividend, reflecting how much investors are willing to pay for $1 of dividends. Best used for comparing dividend stocks over time, but also to other dividend stocks as well. Then there's price to sales, right? If you want to understand for a company that has negative earnings, how much you're pricing, revenue, well, price to sales is a good multiple to look at. Enterprise value to sales, same thing. Now you're looking at the value of the company and its debt relative to those sales figures, most useful once again for companies that aren't yet profitable. This is a huge mix of a lot of ratios. These are not the only ones. These are just some of them. The key here is when you use these things, understand what they're saying. In isolation, they don't mean much. When you start comparing them to company peers, when you start comparing them to sector as a whole, when you start comparing them to the company's historical averages, when you start comparing them to your expectations and what the market is expecting, then you can start to understand a little better how over, under, or fairly valued a company may be. Just as a note, historically, the average trailing PD has been 14 to 16 for the S&P 500. As of Q1, recent levels, like in Q1 22, is 25.5 times. Obviously, since then, there has been significant growth. That's just to say this isn't the only thing you should be looking at, just one piece of the puzzle to understanding the value of a company.